Imagine for a second that you own a company, and you decide to raise the price of your flagship product by a staggering 21%.
Right, which in this economy, that's a massive hike.
Exactly. I mean, basic economics tells us your customer should just run for the hills. Demand should crater, your revenue should collapse, and Wall Street analysts should be calling for your management team to basically resign.
Because that's what we expect, right? We assume that kind of price shock breaks consumer loyalty instantly.
But what if, instead of collapsing, your company generated over $1 billion in pure cash? What if that massive price hike resulted in a 20% jump in earnings per share?
Well, then you are looking at a scenario that challenges almost everything we assume about inflation and consumer behavior.
Welcome to Talk Tickers and today's deep dive, where we are dissecting an absolute masterclass in corporate pricing power, consumer psychology, and sheer financial gravity.
Yeah, because the company we're breaking down today didn't just survive this brutal macroeconomic cycle of rising costs. They actually used it to fundamentally restructure their profit margins.
We're putting the M Smucker Company's Q4 2026 earnings call transcript under a microscope. Ticker symbol is SJM.
And before we get into the heavy data, I think we need to update the mental image most people have of this particular company.
Oh, absolutely. Because for a massive segment of the population, if you say the name Smucker, it conjures up a very specific nostalgic visual.
Right. It's the glass jar of strawberry jelly with the little gingham lid sitting on a grandmother's kitchen counter.
Which is such a dangerous misconception if you are actually evaluating this company as a potential cornerstone of your investment portfolio. I mean, Smucker is no longer just a regional jam company.
Not at all. Through aggressive, multi-billion-dollar portfolio optimization over the last decade, they have mutated into a consumer packaged goods leviathan.
They are an absolute giant now. Today, their portfolio encompasses the largest coffee brands in American retail, an enormous pet food division that basically dictates entire aisles in the grocery store, and a sprawling sweet-baked snacks empire.
We are talking about powerhouse names. Folgers, Café Bustelo, Meow Mix, Milk-Bone, and Hostess brands.
Yeah, the sheer diversity of that product mix means their earnings call functions as a real-time thermometer for the American consumer.
It really does. Whether a family is buying dog treats, grabbing a donut at a convenience store, or brewing their morning caffeine, Smucker's internal data tells us precisely how that household is responding to the pressure of the current economy.
And our mission for this deep dive is to cut through the carefully curated executive phrasing in this transcript. We are going to translate the Wall Street jargon into plain language, into actionable intelligence.
We want to understand the actual mechanics behind their cash flow. What is the strategy behind these price hikes?
And ultimately determine if this stock deserves a place in your portfolio, particularly right now in a market environment where investors are getting increasingly exhausted by these volatile, high-growth tech stocks.
Right, we're seeing a rotation back toward value. And the contrast between a high-flying tech stock and a consumer staple like Smucker is crucial context for you to keep in mind here.
Because tech companies are often valued on what they, might achieve a decade from now. But Smucker is being valued on the tangible, cold, hard cash they literally deposited in the bank yesterday.
So let's examine that cash.
Yeah.
Because the headline numbers for their fourth quarter of fiscal year 2026 are genuinely shocking when you consider the broader retail environment.
The first thing that jumps off the page is the top line revenue. Q4 net sales increased 6%.
And management was careful to note that comparable net sales also increased 6%.
Right, which gives us a very clean baseline because that comparable metric excludes sales from a few pet food brands they recently sold off.
Exactly. And hitting 6% top-line growth in a quarter where consumers are, demonstrably pulling back on discretionary spending, that is a significant victory for management.
It's huge. In fact, this actually marks their 7th consecutive year of comparable top-line growth. They have proven they know how to consistently ring the cash register a little louder every 12 months.
But the revenue growth is just the appetizer here. The main course is what they actually managed to do with that incoming cash.
Right. Top-line revenue grew by 6%, but their adjusted earnings per share, their EPS, came in at $2.76 for the quarter.
Which represents a massive 20% increase versus the prior year.
A 20% jump. The divergence between those two numbers is basically the holy grail of corporate finance.
It really is. Growing your sales by 6%, but growing your actual profit per share by 20% requires a level of operational discipline that, quite frankly, very few management teams possess.
I always think of this dynamic in terms of like a manufacturing plant. Let's say you own a factory making widgets.
Okay.
You have fixed costs, right? Your rent, your heavy machinery, your salaried managers. If you increase your sales by a modest amount, but you do it without needing to lease a whole new building or hire a new tier of middle management,
Then every single new dollar of revenue doesn't have to carry the burden of those fixed costs.
exactly. It just flows almost entirely down to the bottom line as pure profit.
And that concept is known as operational leverage. It is the exact mechanism Smucker triggered this quarter.
The chief financial officer, Tucker Marshall, laid out the mechanics perfectly in the transcript.
He did. He specifically noted that adjusted operating income increased 14%, which was driven by a combination of higher gross profit and highly favorable SG&A expenses.
SG&A meaning selling, general, and administrative expenses. So the overhead required to run the corporate machine.
Precisely. They actively spent less money on marketing and distribution in this specific quarter compared to the prior year.
So they brought more money in the door, but they forcibly clamped down on the internal bloat that usually accompanies that growth.
And the direct result is that disproportionate 20% explosion in earnings per share.
Still, EPS can sometimes be a bit of an accounting illusion. Net income includes non-cash items, things like depreciation on factories or amortization of intangible assets.
Right. It's a vital metric, but it doesn't always tell you how much actual money the company has sitting in its checking account.
Exactly. That's why the number that really stopped me in my tracks was the free cash flow.
Ah, the ultimate truth teller on any financial statement.
They generated a staggering $1.2 billion in full-year free cash flow.
That is an increase of $340 million just from the prior year.
And nearly $500 million of that $494 million, to be exact, was generated just in the fourth quarter alone.
Free cash flow is the lifeblood of strategic maneuvering for these companies. It is the tangible, spendable cash left over after the company has paid all its operating expenses, paid its taxes, and funded its capital expenditures.
Like maintaining their baking equipment and coffee roasting facilities, right?
Exactly.
I like to view a massive consumer packaged goods company like Smucker as a giant boulder sitting at the top of a hill. It has incredible mass, but it needs energy to overcome friction.
Like that.
That $1.2 billion in free cash flow is pure corporate kinetic energy. With that much unencumbered cash, they don't have to go to a bank and beg for a high-interest loan to change the direction of the company.
No, they can deploy that kinetic energy to smash through obstacles, pay down liabilities, or carve entirely new paths in the market.
And what a management team chooses to do with that corporate kinetic energy reveals their core philosophy regarding shareholder value.
A reckless team might use it to make some overpriced, flashy acquisition just to generate news headlines.
Right, but a disciplined team uses it to fortify the foundation of the business. And the transcript shows us exactly which path Smucker chose.
They aimed a massive portion of that cash directly at their liabilities. They paid down $720 million in debt in fiscal 2026.
Eliminating nearly $750 million of debt in a 12-month window, especially in an era of elevated interest rates, is a phenomenal defensive maneuver.
It really is. They finished the year with a net total debt balance of $6.9 billion.
And the transcript notes that based on their trailing 12-month adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, coming in at approximately $1.8 billion, their leverage ratio now stands at 3.8 times.
We really need to contextualize that 3.8 times leverage ratio for the listener.
Yeah, break that down.
When a company transforms its portfolio by acquiring behemoths like Hostess brands, it usually has to take on a mountain of debt to finance the purchase. The leverage ratio tells investors how many years it would take the company to pay off all its debt if its earnings stayed completely flat and they devoted every single penny of profit to debt reduction.
I think the best way to visualize this is through a personal finance lens. Imagine a family that brings home $100,000 a year in steady income.
Okay.
If that family takes out a $380,000 mortgage to buy a house, they have a personal leverage ratio of 3.8 times their income.
That makes perfect sense. And for a volatile, unproven tech startup, owing almost 4 times what you make in a year could be an absolute death sentence if a recession hits.
But for a consumer staples company selling coffee and pet food, it's a much more manageable mortgage.
Because the cash flows are highly predictable. I mean, even in a recession, people feed their cats and drink coffee.
Right. However, A 3.8 times ratio is still a bit higher than a conservative management team typically wants to carry long term.
Because high debt translates to high interest expense, which just constantly bleeds cash away from shareholders.
So taking that $1.2 billion in free cash flow and forcefully aiming $720 million of it at that debt pile proves they are actively de-risking the balance sheet.
And they also make sure to reward the people actually holding the stock. The transcript highlights they returned $465 million of cash directly to shareholders through dividends in the fiscal year.
Another massive payload delivered straight into the pockets of the investors, which really reinforces that value proposition.
So if we look purely at the aggregate data, the narrative is flawless.
Right. Sales are up 6%, EPS is up 20%. They were generating over $1 billion in free cash flow, aggressively burning down debt, and paying nearly $500 million in dividends.
It paints a picture of an invincible corporate machine.
But I have to push back here.
I figured you would.
We cannot take these aggregate numbers at face value in our current macroeconomic climate.
You were looking for the quality of the revenue.
I am. We have all been living through a period of historic inflation. The cost of labor, packaging, freight, and raw materials has just surged.
It's been brutal across the board.
So my core question is, how much of that 6% sales growth is actual organic growth? Are they genuinely convincing more people to buy more bags of coffee and more boxes of snacks?
Or are they simply jacking up the price on the consumer to cover their own rising costs?
Exactly. Are they growing the business, or are they just squeezing an exhausted consumer base?
To answer that, we have to basically tear up the aggregate grocery receipt and look line by line.
Right into the segment breakdown provided by management.
Because the micro stories driving these headline numbers reveal a massive tension between pricing power and consumer loyalty.
Let's start in the coffee aisle. The U.S. retail coffee segment is where this tension is probably most visible.
The headline from the CFO is that sales jumped 12% versus the prior year.
And a 12% growth rate in a legacy category like coffee sounds phenomenal.
Until you look at the composition of that growth.
Let's hear it.
The CFO, Tucker Marshall, provided a very specific breakdown. Net price realization increased net sales by 21 percentage points. However, volume mix decreased net sales by 8 percentage points.
Okay, let's strip away the corporate freezing here. Net price realization means they changed the sticker price on the shelf. They charged 21% more for their coffee products.
Right.
And volume mix decreasing means shoppers put 8% fewer bags and cans of Smucker coffee into their physical shopping carts.
They charged a fifth more for the product, and as a direct result, almost a tenth of their physical volume just vanished.
This is a textbook, real-world demonstration of the price elasticity of demand.
Economic theory coming to life on the grocery store shelf. In classical economics, if you dramatically raise the price of a good, demand falls.
But coffee holds a unique psychological space for the consumer, right? It's generally considered relatively inelastic.
Because caffeine is a deeply ingrained physical habit. It's practically a daily necessity for millions of workers.
So when Smucker faced a massive surge in their own commodity costs, specifically the price of green coffee beans on the global market, they made the calculated decision to pass a massive 21% price hike directly onto the consumer.
And the gamble mostly paid off, mathematically speaking. Yes, they lost 8% of their volume, which the transcript notes was driven heavily by declines in the legacy Dunkin' and Folgers brands.
But a 21% price increase minus an 8% volume drop still nets out to a 12% overall increase in top-line dollar sale.
Right. They sacrifice volume to protect their profit dollars. It highlights the sheer pricing power inherent in the coffee category.
But losing 8% of your physical volume is a dangerous game to play long-term, you know?
It absolutely is.
Yeah.
There was, however, a massive anomaly in that coffee portfolio. One brand completely defied the downward volume trend.
Yeah, the CEO, Mark Smucker, spent a significant portion of his remarks highlighting Café Bustelo.
He stated this specific brand saw a staggering 39% net sales growth for the entire fiscal year.
Achieving nearly 40% growth on a coffee brand during a period where you are implementing double-digit price hikes is almost unheard of in the consumer staples sector.
It's wild. The CEO detailed exactly how they achieved it. Café Bustelo historically had a very specific regional demographic.
But Smucker is executing this massive geographic expansion, pushing the brand aggressively into the central and west coast regions of the United States.
They are leveraging highly targeted cultural marketing. staying authentic to the brand's Latin roots, while simultaneously introducing it to a broader demographic looking for an espresso-style roast.
So they're turning a regional favorite into a national powerhouse.
Which is a critical offset because the U.S. retail coffee segment faced some severe unexpected headwinds alongside those raw material costs.
Right. The CFO explicitly mentioned tariffs in his remarks. He noted that tariffs realized approximately $23 million in sudden expense just in the fourth quarter, primarily impacting this specific coffee segment.
And let's be very clear on our rules of engagement here regarding external factors. The transcript cites tariffs, and later on, management points to geopolitical uncertainty in the Middle East as a supply chain risk factor.
We are analyzing these elements strictly through the lens of corporate finance. We are not taking any political stance on trade policy, domestic manufacturing incentives, or global conflicts.
Our sole focus is interpreting how these realities impact Smucker's balance sheet and your potential investment.
Exactly. From a purely analytical standpoint, an unexpected $23 million expense hitting a single segment in a single quarter is a material blow to gross margins.
It really underscores how exposed consumer packaged goods companies are to global trade winds.
And it makes that 12% top-line revenue growth even more essential. I mean, without that aggressive 21% price hike, those tariff costs would have completely eviscerated their quarterly profit.
Absolutely. Moving from the coffee aisle to the freezer section, we encounter the U.S. retail frozen handheld and spreads segment.
Which is a very long corporate name for a division that is functionally dominated by one absolute superstar product.
Uncrustables.
Uncrustables. Now, the overall segment net sales only increased 1% versus the prior year, which sounds incredibly anemic.
It does. But when you dig into the segment data, you realize the broader spreads category is basically dragging down a rocket ship.
The CEO noted that net sales for the Uncrustables brand accelerated sequentially, increasing 8% in the quarter. He specifically called it their strongest quarterly growth rate of the entire fiscal year.
And this culminated in a massive corporate milestone. The CEO formally announced that Uncrustables has officially crossed the threshold to become a $1 billion brand.
I really want you to internalize that number for a second. A frozen crustless peanut butter and jelly sandwich is generating $1 billion in annual sales.
It is an astonishing feat of consumer product engineering and marketing.
The transcript provides the underlying metrics supporting that billion-dollar figure, too. Management noted the brand added approximately 3 million new households to its consumer base over the past year.
It heavily over-indexes to households with children, millennials, and Gen Z consumers. But the most fascinating metric to me is the distribution split.
Right.
They generate about 75% of those sales in traditional U.S. retail, your standard grocery stores, and big box retailers.
Yeah.
The remaining 25% comes from the away-from-home segment.
And we need to unpack that away-from-home business because it fundamentally changes the risk profile of the revenue.
The away-from-home channel encompasses schools, hospital networks, corporate cafeterias, and lodging.
The economics of institutional contracts are wildly different from fighting for shelf space at a local grocery store.
Completely different. If a consumer's walking down a grocery aisle, they might decide to skip the Uncrustables this week because the store brand alternative is $1 cheaper.
Or simply because they're just trying to save money that week.
Yeah.
That is highly volatile, mood-based purchasing.
But if Smucker secures a multi-year contract to supply portion-controlled fruit spreads and Uncrustables to a massive regional hospital network or a massive school district, that revenue is locked in.
Yeah, the hospital doesn't stop buying sandwiches just because consumer sentiment dipped on a Tuesday.
Exactly. It provides a dense, predictable, high-margin layer of cash flow that really insulates the company from the day-to-day whims of the retail shopper.
And they are actively working to accelerate the retail side of the brand by introducing a major logistical innovation. Management dedicated significant time to discussing the launch of fridge-friendly Uncrustables.
It sounds like a minor tweak, but it actually represents a massive shift in how the product is consumed.
Right, because historically, Uncrustables were strictly a frozen item. You had to keep them in the freezer and remember to pull them out to thaw before eating.
And the new formulation allows the product to stay fresh in a standard refrigerator for up to 5 days.
So why does management view this as a primary growth driver? I mean, it's just a fridge.
It comes down to friction removal. Think about the core demographic. Busy parents trying to streamline the chaotic morning routine of packing school lunches. In the old model, having to remember to pull a frozen sandwich out every single morning is a point of friction. If you forget, the lunch is ruined.
Ah, I see. The new model changes the behavior. A parent can buy a box on Sunday, throw the entire thing in the refrigerator, and seamlessly grab one every morning for the next 5 days without thinking about thaw times.
Exactly. Management explicitly stated this innovation creates even more convenience, flexibility, and everyday usage occasions.
By removing the friction of thawing, they are actively increasing the velocity at which the product is consumed.
A household that previously ate 2 Uncrustables a week might now consume 5, simply because the barrier to immediate consumption has been lowered.
And they desperately need Uncrustables to maintain that velocity because the rest of that specific segment is struggling.
The transcript noted that sales for their traditional spreads portfolio, the actual jars of peanut butter and jelly, actually declined in the quarter.
They attributed this decline to broader category dynamics, but also to a deliberate strategic decision not to repeat certain promotional activity from the prior year.
Essentially, they chose not to run as many sales or discount campaigns for their peanut butter and jelly.
Which is a classic margin protection strategy. By refusing to discount the product, they sacrifice top-line revenue volume, but they ensure that every single jar they do sell carries a higher profit margin.
Right. It is a constant calibration between market share and profitability.
Let's pivot to the pet aisle. U.S. retail pet foods.
Net sales in this segment increased 2%.
The pricing mechanics here look very similar to the broader company trend. Net price realization increased sales by 3 percentage points, while the volume mix decreased sales by 2 percentage points.
Another instance of raising prices and taking a slight hit on the volume, but the aggregate pet segment number hides a really fierce divergence between their feline and canine portfolios.
The internal dynamics are a literal tale of two animals. The cats are carrying the segment while the dogs are dragging it down.
The CEO highlighted that the Meow Mix brand accelerated significantly, delivering 8% net sales growth in dry cat food.
He also noted that dry cat food represents a massive 85% of their entire cat food portfolio. They are actively gaining dollar share in a growing category.
And they are fueling this growth through what management termed consumer-led innovation.
We have to specifically highlight the marketing campaign they cited here because it is a masterclass in consumer packaged goods branding. They attribute significant growth to the Meow Mix Gravyverse innovation.
Building a cinematic universe for cat food is, frankly, brilliant marketing.
The CEO stated it was the leading innovation in the entire dry cat food category last year. But while the Meow Mix portfolio is thriving, the dog side of the aisle is really struggling.
The transcript explicitly called out a 1% decline in dog snacks for the quarter, pointing directly to softness in the legacy Milk-Bone brand, particularly in their standard biscuits.
If we zoom out and look at the macro environment, this divergence between dry cat food and dog treats makes perfect economic sense.
It reveals the line consumers draw between non-discretionary and discretionary spending.
Right, because if you own a cat, purchasing their core daily meal like a massive bag of dry Meow Mix is a non-negotiable expense. You have to feed the animal. It is a mandatory household budget item.
But a box of Milk-Bone biscuits, that is entirely discretionary. It is a treat.
When a family is feeling the crushing weight of inflation across their entire budget, when they are paying 21% more for their Folgers coffee and seeing their grocery bill spike, they might quietly skip the extra box of dog treats to save $5.
The dog won't know the difference, and the family protects its cash flow.
Recognizing this pressure, management outlined a stabilization plan for Milk-Bone. They are attempting to revitalize the brand by migrating into premium offerings.
Specifically highlighting Milk-Bone Peanut Buttery Bites, which they claim was the #1 dog snack launch over the past 4 years.
They are trying to offer a product that feels unique enough to justify that discretionary spend.
They are also restructuring how they sell it. The transcript notes they are leaning heavily into e-commerce, pointing out that e-commerce now represents about 1/3 of the total dog snacks category.
And Smucker is seeing strong growth in that channel.
The shift to e-commerce in the pet category is a structural advantage for massive companies. Dog food and large boxes of treats are heavy, bulky items.
Consumers increasingly prefer to have them delivered directly to their doorstep through services like Amazon or Chewy, often utilizing those subscribe and save models.
That subscription model changes the financial equation entirely. If a consumer subscribes to receive a box of Milk-Bone every month, they're significantly less likely to actively log in and cancel it during a tight month compared to simply walking past it in the physical grocery aisle.
It transforms a volatile, discretionary retail purchase into a sticky, recurring revenue stream.
Exactly. I mean, that is the critical piece here. Securing those recurring e-commerce channels is absolutely vital for stabilizing the pet portfolio.
Now we have to examine the segment that likely caused the executive team the most sleepless nights this year: sweet baked snacks.
This is the massive portfolio they largely acquired when they purchased Hostess brands.
And the fourth quarter numbers for this newly acquired empire are rough. Net sales decreased 5%.
Even if you factor out some minor divestitures to look at comparable net sales, this segment still shrank by 4%.
But the truly alarming metric is the internal price-to-volume ratio. This is where the alarm bells start ringing loudly for anyone paying attention to consumer exhaustion.
The CFO provided the exact breakdown. Higher net price realization increased net sales by 8 percentage points. But volume mix fell a staggering 12 percentage points, heavily dragged down by declines in snack cakes and breakfast items.
This is the moment I have to raise a massive red flag.
Go for it.
We saw the data in the coffee segment. They raised coffee prices 21%, and the volume only dropped 8%. In the sweet baked snacks segment, they raised prices by a much more modest 8%, but the volume completely collapsed by 12%. Are they just squeezing blood from a stone at this point?
It's a fair question.
How long can a company keep pulling the price lever before the consumer simply walks away and switches to a cheaper store brand, or worse, stops buying the category entirely?
You are identifying the absolute limit of their pricing power here. This stark contrast perfectly illustrates the difference between an ingrained physical habit and a discretionary indulgence.
Yeah.
A consumer might grumble about paying more for their morning caffeine, but they will generally pay it. But a Twinkie or a Hostess cupcake, that is a purely discretionary purchase.
The data clearly shows that consumers have a hard breaking point. When the price of that snack cake crossed a certain psychological threshold, 12% of the volume simply vanished.
The consumer decided the indulgence was no longer worth the premium price.
There was, however, a defensive anchor within that snack aisle that actually performed well.
The Hostess donuts. The CEO made sure to highlight that Hostess donuts grew net sales by 13% in the quarter.
He also pointed out that this specific brand represents roughly 40% of their entire sweet baked snacks portfolio.
So the donuts are essentially acting as a firewall, preventing the entire segment from completely collapsing under the weight of the snack cake declines.
They also spent time detailing their recovery from a major operational hurdle in this division.
Right. Management discussed a fire that occurred at their Emporia, Kansas manufacturing facility back in February.
The CFO noted that their Q4 sales in the snacks segment actually exceeded their own internal revised expectations because the operations team managed a faster than anticipated return to production following that fire.
Beyond just recovering from the fire, they have been aggressively executing a classic post-acquisition playbook. They are consolidating manufacturing plants and deeply engaging in SKU rationalization.
SKU stands for Stock Keeping Unit. SKU rationalization is the process of analyzing your entire product catalog and ruthlessly cutting the items that are underperforming or carrying low profit margins.
If a specific seasonal variation of a snack cake requires special packaging, slows down the manufacturing line, and only appeals to a tiny niche of buyers, a disciplined management team will kill that product.
It hurts your top-line revenue because you are intentionally selling fewer items, but it dramatically increases the efficiency of your factories.
The CEO stated that these consolidation and rationalization actions significantly improved profitability this quarter. He projected a clear path to returning this segment to margins in the low to mid-teens moving forward.
You buy a massive, slightly inefficient brand like Hostess, you trim the fat, you close redundant facilities, you cut the low-margin products, and you extract maximum cash flow from the remaining core products.
It's painful in the short term, as evidenced by that 12% volume drop, but it is entirely necessary for long-term margin health.
Before we close the book on the historical data, we need to touch on a structural change to their reporting. The away-from-home business, which we touched on earlier regarding Uncrustables, has officially been promoted.
During the opening remarks, Crystal Biding, the VP of Investor Relations, noted that they completed an internal evaluation and the away-from-home business finally met the criteria to be presented as its own distinct, reportable segment.
It is now large enough to stand on its own in the financial filings. And the initial numbers really justify the promotion. Sales in this newly independent segment spiked 15%, or 14% if you exclude favorable foreign exchange impacts.
The CFO attributed this massive growth directly to the institutional strength of Uncrustables, portion control fruit spreads, and their commercial coffee solutions.
We discussed the stickiness of hospital and school contracts earlier, but the CEO made a broader point about this entire channel. He emphasized that the away-from-home mix has proven incredibly durable across various economic cycles.
They have structured their contracts to limit their exposure to the restaurant industry, which is notoriously volatile during economic downturns.
By focusing on lodging, healthcare, schools, and convenience stores, they have built a high-margin fortress that provides a stable foundation underneath the wild swings of their retail grocery aisles.
Synthesizing the story behind the 2026 numbers, Smucker successfully weaponized their pricing power to pass their own commodity inflation onto the consumer.
The strategy worked brilliantly in the inelastic coffee segment, it worked acceptably in the pet food division, and it caused significant volume damage in the discretionary sweet-baked snacks portfolio.
But in the aggregate, they managed this incredibly delicate balancing act to deliver massive EPS growth and over $1 billion in free cash flow.
But this entire strategy was built for an inflationary environment.
Right.
The macro environment is shifting beneath their feet. We're seeing signs that inflation is finally cooling in certain key commodities. What happens when the cost of the raw materials actually goes down? Can they maintain these prices, or does the entire equation break?
That question brings us directly to the most vital part of this analysis: management guidance for fiscal year 2027.
Because what Smucker is projecting for the next 12 months is one of the most fascinating, counterintuitive corporate dynamics I have seen in recent market history.
It is a masterclass in the divergence between revenue and profit. Let's start with the top line, which offers a genuine shock to the system.
Management is officially guiding that net sales for fiscal year 2027 are expected to decrease by 3 to 4%.
If you are a retail investor merely skimming the headline summary on a financial news app, a projected 4% revenue decline sounds catastrophic.
It sounds like a shrinking company losing market share. The immediate instinct is to sell the stock.
But you have to read the very next line in the transcript. The bottom line projection is a massive boom.
Despite the shrinking revenue, they expect adjusted EPS to come in between $9.75 and $10.25.
At the midpoint of that guidance range, that represents a 9% increase over the incredible, record-breaking year they just finished.
This is where we really need to slow down and map out the math for you. Management is telling Wall Street that their sales are going to shrink by up to 4%. Less money is coming in the door.
Yet their actual earnings per share are going to grow by 9%.
Furthermore, they project they will still generate another $1 billion in free cash flow. How is that mathematically possible?
The CFO, Tucker Marshall, spent a significant amount of time explaining this exact dynamic, and it all revolves around two words: green coffee.
Let's get into the weeds of the global commodities market.
The CEO, Mark Smucker, stated explicitly that they're beginning to see a material moderation in the cost of the green coffee commodity, supported by positive early indications for the upcoming global crop yields.
Green coffee refers to the raw, unroasted beans that Smucker purchases by the ton on the global commodities market to manufacture Folgers and Café Bustelo.
So the foundational raw material for their largest segment is getting significantly cheaper.
Yes. Now, we have to understand how the coffee category operates internally. Management refers to coffee as a pass-through category.
Let's define the mechanics of a pass-through category for the listener.
Because the input cost of raw coffee beans is notoriously volatile, subject to weather patterns and global supply chains, consumer packaged goods companies generally pass those fluctuating costs directly through to the consumer at the grocery store.
They pass through the highs and they pass through the lows.
When green coffee was astronomically expensive last year, Smucker protected their margin dollars by raising retail prices 21%.
Now that green coffee deflation is occurring, Smucker is contractually and competitively obligated to lower prices on the shelf to match.
The CEO confirmed this, stating they have already begun lowering prices through trade investments and planned list price decreases.
Which brings us to a really great analogy.
Right. I want to jump in here with an analogy to make this complex margin dynamic crystal clear. Think of Smucker's coffee business like a massive, high-volume local gas station.
The mechanics are remarkably similar.
When the global price of crude oil skyrockets, the gas station owner is forced to raise the price on the big sign out front to, say, $4 a gallon, just to cover the cost of filling their underground tanks.
Because the price is so high, their total daily revenue goes way up. Every single transaction at the register is larger.
But the owner isn't actually making significantly more profit per gallon. They are just passing the massive cost of the crude oil along to the driver.
The revenue inflates, but the profit margin remains static.
Now, imagine the price of global crude oil suddenly plummets. The gas station owner lowers the price on the sign down to $3 a gallon.
If they sell the exact same number of gallons that day, their total top-line revenue drops significantly. The cash register is ringing up much smaller numbers. The business appears to be shrinking.
But here is the magic in the math. If the cost of the raw crude oil dropped even faster than the price the owner lowered on the sign for the consumer, their actual profit margin per gallon expands dramatically.
Boom. That is exactly the dynamic playing out across Smucker's multi-billion-dollar coffee portfolio.
Total revenue for the company is shrinking because they are guiding for a mid-single-digit percentage decline in net price realization for the U.S. retail coffee segment. They are literally charging the consumer less money for coffee.
But because the cost of the raw green beans plummeted so severely, the spread between their cost and their retail price is widening. Their profit margins are exploding.
The CFO laid out the exact anticipated impact of this spread. He anticipates that the full-year adjusted gross profit margin for the entire company will expand by roughly 300 basis points, bringing the total gross margin to approximately 38%.
300 basis points. For anyone unfamiliar with the terminology, 1 basis point is 0.01%.
So an expansion of 300 basis points equates to a full 3% expansion in pure profit margin across the entire enterprise.
In the razor-thin margin world of consumer staples, moving your gross margin from 35% to 38% is a tectonic shift. It generates an ocean of bottom-line cash.
That massive margin expansion is the engine that allows them to confidently project 9% EPS growth and another $1 billion in free cash flow, even while they acknowledge that top-line sales will physically shrink.
It is a brilliant display of managing for profit rather than managing for vanity revenue metrics.
But generating $1 billion in cash is only half the equation. We must examine their capital allocation strategy for 2027. What exactly do they plan to do with that newly minted $1 billion?
The transcript shows a strategy that is remarkably consistent with their actions in 2026. The CFO stated their primary target remains the balance sheet. They plan to pay down another $500 million in debt.
After paying down $720 million last year, targeting another $500 million this year shows a relentless, systematic attack on their corporate liabilities.
And he provided a very specific destination for this deleveraging journey. With that anticipated $500 million pay down and their expected 9% earnings growth, they project their leverage ratio will drop to around 3.0 times net debt to adjusted EBITDA by the end of fiscal year 2027.
Bringing that ratio down from 3.8 times to 3.0 times in a 24-month window fundamentally alters the risk profile of the company. It provides immense security for equity holders.
It also has an immediate, tangible benefit to the income statement. The transcript notes their expected net interest expense for the coming year is approximately $345 million.
That is $345 million in cash that simply evaporates to service their loans. By aggressively paying down the principal, they actively shrink that future interest burden, freeing up even more structural cash flow for the years to come.
They also address the dividend, which is paramount for a large portion of their investor base.
The CFO made it explicitly clear that they expect the board of directors to maintain the current dividend policy. That policy dictates a payout of 40 to 45% of their annual adjusted earnings per share.
Because they are projecting EPS to grow by 9%, adhering to that strict 40 to 45% payout ratio guarantees that the dividend payout will grow alongside the earnings.
The CEO proudly highlighted that they boast 24 consecutive fiscal years of dividend growth.
A quarter century of consecutive dividend increases is a remarkable track record of returning capital.
But they aren't just funneling all the cash back to the banks and the shareholders. A crucial detail in the 2027 guidance is how they plan to fund their own internal future.
The CFO noted that they expect SG&A expenses to increase by about 5% in the coming year. A major driver of that internal cost increase is a strategic surge in marketing.
He estimated that total marketing expense will reach 5.7% of net sales.
Right.
That represents an increase of roughly 60 basis points, or approximately $30 million in additional ad spend versus the prior year.
They're taking a massive chunk of that newly generated profit margin and plowing $30 million directly into marketing what they call their key growth platforms.
We know exactly what those platforms are. Uncrustables, Café Bustelo, Meow and Milkbone.
They are aggressively defending their most profitable territories. They are basically building a moat around their hero brands.
They want the fridge-friendly Uncrustables in every single American refrigerator. They want Café Bustelo dominating the espresso roast market. And they want the Meow mixed gravyverse capturing every new pet owner.
We have spent a significant amount of time sifting through the historical sales data, the EPS jumps, the massive cash flow generation, the nuanced segment dramas between coffee and snacks, and management's margin expanding guidance for 2027.
We need to distill this mountain of data.
It is time to synthesize all of this intelligence into a final verdict for you, the retail investor listening to this breakdown. Based on the hard data and the executive commentary we've unpacked today, what is the actionable takeaway? Is this earnings call a bullish or bearish signal for JM Smucker stock?
If we contextualize this transcript within the broader reality of the current stock market, I believe we must take a definitive, strongly bullish stance, but for a very specific archetype of investor.
I agree completely. If you are a momentum trader, someone looking for a high-flying tech stock to deliver a 50% revenue pop in the next 3 months, driven by AI hype, this is absolutely not the stock for you. Smucker is projecting shrinking revenue.
But if you are a value investor or an income-focused dividend investor looking for stability in a volatile world, this transcript is a bullish masterpiece.
This entire earnings call was a masterclass in mature capital discipline. The management team is not chasing unprofitable vanity top-line revenue growth just to appease short-term Wall Street analysts.
They possess the maturity to embrace a deliberate 3 to 4% revenue decline because they understand it is the necessary mechanism to restore their profit margins. Delivering 300 basis points of gross margin expansion in a single year is the defining victory of this report.
And their relentless, almost surgical focus on repairing the balance sheet is exactly the behavior you want to see from a management team operating in a high-interest rate environment.
By systematically deleveraging the company and targeting that 3.0 times ratio by the end of FY27, they are drastically lowering their interest expense and de-risking the entire corporate structure.
Furthermore, their decision to self-fund their own future by pouring an additional $30 million into marketing their hero platforms ensures that when the macroeconomic environment eventually normalizes and the consumer feels less pressured, brands like Uncrustables and Café Bustelo will possess even deeper market penetration.
Let's make this highly actionable for you. If you currently hold SJM stock in your portfolio, those 24 consecutive years of dividend growth look incredibly safe. The dividend is backed by a projected $1 billion in free cash flow and a very conservative 40 to 45% payout policy.
Management is not stretching their balance sheet or taking on debt to pay that dividend. It is comfortably, organically covered by their massive cash generation.
And if you are an investor sitting on cash, considering initiating a position in this stock, you are looking at a highly defensive equity.
We should define defensive in this context for those newer to portfolio construction.
A defensive stock is an equity that provides consistent dividends and highly stable earnings regardless of the overall state of the stock market or the broader economy. It acts as ballast for your portfolio.
We are looking at a company built on recession-resistant brands. Even in a severe, protracted economic downturn, basic human and pet behaviors remain static.
People are still going to buy dry cat food because the pet must eat. Parents are still going to buy Uncrustable PB&Js for school lunches. And workers are still going to drink coffee in their kitchens every morning.
It is the ultimate sleep well at night portfolio edition. However, in the spirit of our objective data-forward mandate, we cannot simply cheerlead the stock.
A true expert analysis requires deeply examining the downside risks that management themselves felt compelled to highlight on the call.
There were two significant external wildcards they pointed out that have the potential to severely derail this beautiful 2027 margin guidance.
Let's lay those risks out clearly.
First, the CFO explicitly mentioned that their guidance factors in increased costs stemming from elevated geopolitical uncertainty related to the Middle East.
Again, we are viewing this strictly through a logistics and financial lens. The global supply chains that move raw commodities like coffee beans, as well as the materials required for complex packaging, rely heavily on international shipping routes through that region.
Any sudden disruption or escalation there causes global freight and insurance costs to spike violently. If shipping costs double overnight, that beautiful 38% margin projection gets eaten alive by logistics expenses.
The supply chain is always the Achilles heel of a global CPG company, and the second risk is perhaps an even more unpredictable wildcard: tariffs.
The transcript explicitly states a massive caveat. The CFO noted that their FY27 guidance, quote, does not assume any impacts from new or changes to existing tariffs or tariff refunds.
That is a staggering disclaimer, especially considering we already noted that tariffs cost them $23 million in the fourth quarter alone.
If domestic trade policies shift aggressively in the coming year, and sudden new tariffs are slapped on imported agricultural goods like green coffee, or on the raw materials used to package their snacks, Smucker's entire cost structure could get scrambled overnight.
They would be forced into a brutal choice. Either eat the tariff cost and destroy that 300 basis point margin expansion, or attempt to pass the cost onto a consumer base that we already know is exhausted by 3 years of relentless inflation.
It highlights the delicate ecosystem these companies operate within. Management has built an absolute fortress of a balance sheet with that $1.2 billion in free cash flow. But the walls of that fortress are still entirely subject to the unpredictable weather of global economics.
We have covered a massive amount of ground in this deep dive. We traced the path of $1.2 billion in free cash flow. We examined the fascinating elasticity dynamics separating an ingrained habit like coffee from a discretionary purchase like sweet-baked snacks.
We explored the strategic value of institutional away-from-home contracts, and we unpacked the counterintuitive magic of margin expansion through green coffee deflation.
The complexity of this single earnings call highlights exactly why you can never just read a top-line revenue headline on a blog and assume you understand the health of a business.
The real story is always buried in the segment margins and the cash flow statement.
Never trust the aggregate grocery receipt. But as we wrap up this deep dive, I want to leave you with a final provocative thought to mull over. Something that builds on everything we've discussed today regarding elasticity and pricing power, but looks slightly beyond the horizon of the specific earnings call.
Let's hear.
Smucker proved definitively over the last year that they possess the sheer pricing power to pass massive inflationary costs onto the consumer. They raised prices aggressively across their entire portfolio, and financially, the strategy worked.
They protected their profit dollars, even if it meant absorbing an 8% volume loss in coffee and a very painful 12% volume drop in sweet-baked snacks.
But here is the lingering psychological question. Human purchasing behavior is incredibly sticky.
It takes immense effort to change a consumer's habit, but once it changes, it tends to stay changed.
So as Smucker now begins to aggressively lower their retail prices due to this green coffee deflation, will those lost consumers actually come back?
That is the multi-billion-dollar question facing this management team over the next 12 months.
Think about the real-world application. If a family has bought Folgers coffee every week for a decade, but finally stopped last year because the price suddenly jumped 21%, they likely begrudgingly switch to a generic store brand coffee to save money.
They have been drinking that cheaper store brand for the last 8 months.
What happens now that Smucker lowers the price of Folgers back down? Did that family get used to the taste of the cheaper store brand? Did they realize it's perfectly fine and permanently decide they don't need to pay a premium for the Smucker label?
Did that agonizing period of high prices permanently push a massive segment of legacy buyers entirely out of the Smucker ecosystem?
It is a profound structural risk for any legacy brand. Price hikes have the potential to destroy decades of brand loyalty in a way that subsequent price cuts cannot easily repair. Price memory is a powerful force.
So as you monitor SJM stock in your portfolio over the coming year, I urge you not to just blindly stare at the profit margins and the EPS beats. Look deeper.
Keep an eagle eye on the specific volume numbers in the quarterly segment reports. Management has explicitly stated they expect volume mix growth to return across their key platforms.
But the reality of the grocery store aisle will tell the true, unfiltered story.
If they lower their prices and that 8% coffee volume and 12% snack volume do not bounce back, it will signal that brand loyalty is not forever. It will tell us that the brutal inflationary shocks of 2026 may have permanently altered the American consumer landscape.
Monitoring that volume recovery will be the ultimate test of the enduring cultural power of these legacy brands.
Thank you all for joining us on this edition of Talk Tickers. Our goal with every deep dive is always to translate the dense corporate jargon into clear, actionable intelligence for your portfolio.
We hope we've given you a new framework for analyzing consumer staples in this chaotic market.
Remember to stay data forward, question the easy headlines, and relentlessly keep digging into the numbers. We will see you on the next deep dive.